Our second video from Chapter 10 is on liquidating distributions and the basis adjustment. Liquidating distribution is a distribution that terminates the partner's interest in the partnership. The basis of the partner's interest must be zero. We've seen a lot of cases already where the partner remains a partner, but the basis in the partnership interest is zero. However, here's a case where the partner is not going to be a partner anymore, and in this case, the partner's interest must be zero. So that's the difference. A continuing partner's basis can be zero. A retiring partner's basis must become zero. General treatment of a liquidating distribution: reduce the basis in the partnership interest by the amount of the cash distributed. If cash exceeds basis, you're at zero then. Recognize a capital gain to make sure the basis doesn't go negative. Reduce the basis in the partnership interest by the partnership's basis in the hot assets distributed, but again, not below zero. Any remaining basis is allocated to other assets distributed, if any. If there are no other assets distributed, then the partner will recognize a loss because you got to get that basis to zero. We have another spreadsheet. It's in Concept Summary 10.3. It's very similar to what we saw in Concept Summary 10.2 for non-liquidating distributions. Similar, but not the same. We'll see that there are differences. So there is the spreadsheet. We have the same four inputs, and they're exactly what they were before. Partner's outside basis before anything happens. Then the cash and deemed cash distributions, the hot asset distributions, and the basis in any other distributed property. But notice there's an instruction there. If no other property was distributed, don't just put a zero, because it could have been other distributed property with a zero basis. Could have fully depreciated equipment, for example. But put an NA there if nothing was distributed, because we're going to need to have the spreadsheet be able to distinguish between property with a zero basis or nothing was distributed. There's the formulas. And again, they're basically pretty simple. There are a couple of if statements at the bottom. Then notice the very last item there, the bottom one, item 11, partners remaining outside basis, is zero. That's not even a formula. That's just zero. Problem number 30. Let's see how this works. Paula's basis in her partnership interest is $60,000. In liquidation of her interest, the partnership makes proportionate distribution to Paula of $20,000 cash and inventory, basis of $5,000 and value of $7,000 for that inventory. No other property was distributed, so just the cash and the appreciated inventory. Assume that the partnership also liquidates. So this is a proportionate distribution. Paula's getting out, but so are all the other partners. So there is our spreadsheet. Notice the NA for the partnership's basis in other distributed property. Paula didn't get any of that other distributed property. Maybe there was no other property to distribute because none of the other partners probably got any either, since we were assuming it was proportionate. So she had an outside basis of $60,000. She got $20,000 in cash and $5,000 in that appreciated inventory. Starts with an outside basis of $60,000. Subtract out the cash. No gain recognized because the cash is less than her basis. So she has remaining basis at that point of $40,000. Basis in the distributed hot assets is $5,000. Basis, partner's basis in those assets will also be $5,000. She cannot take a greater than partnership basis in a hot asset. If it was a cash basis account receivable, it would have to be a basis of zero. You cannot increase the basis of your hot assets, even with a liquidating distribution. So her remaining outside basis is then $35,000. Partnership's basis in the other distributed property, not applicable. There was no other distributed property. Partnership's basis in the other distributed property, if NA enters 0, because there is no property there. So it was NA, so we enter 0. Loss recognized by the partner if line 8 is NA, which it is, enter line 7, $35,000. Otherwise, enter 0. No loss if you got some other distributed property, but you will recognize a loss, and so therefore she will, because she didn't get any of that other distributed property, so she has a $35,000 recognized loss. Partner's remaining outside basis is and must always be in a liquidating distribution 0. So letter B, based on the information in your spreadsheet, how much gain or loss, if any, will Paula recognize on the distribution? The answer is a $35,000 loss. What basis does Paula take in the inventory? $5,000. Letter D, what happens if the partnership also distributes artwork to Paula with a basis of $1,000 and a fair market value of $30,000? Adjust the input section and explain your answer. So here's letter D. Took out that NA and put in $1,000 for that artwork. Still no gain recognized because the cash is less than her starting outside basis. The inventory is going to come in at $5,000, so she's got that outside basis of $35,000. But now she did get some other distributed property, the artwork, with a basis of $1,000. She's going to take that artwork with a basis of $35,000. And the loss recognized by the partner will be 0. And her remaining basis, because she took the artwork at a $35,000 basis, she has zeroed out her partnership interest that way. So it is, again, 0. Letter E, return to the original facts. Conceptually, how would your answers to parts B or C change if this had been a current distribution? No gain or loss would be recognized, and the basis in Paula's partnership interest would be $35,000. That's the big difference, that Paula's basis does not have to go to 0 if it's a non-liquidating distribution. Problem number 32 is a very sad tale of woe. Let's read it. Ebony has a basis in her partnership interest of $85,000. In a proportionate liquidating distribution of the partnership, Ebony receives $5,000 cash and a car, which is a Section 1231 asset of the partnership. And the basis of the car is $20,000, fair market value $30,000. Disregard any potential depreciation recapture on the car. Letter A, how much loss, if any, may Ebony recognize on the distribution? Answer, no loss is recognized, because she's going to take cash at its fair market value, and then whatever basis she has left over, she's going to put that to the car, which is not a hot asset, it's just another asset. Now, Ebony's basis in the car is $80,000. So she's sitting there with this $80,000 car, but it's not an $80,000 car. It's a car with a fair market value of $30,000. But Ebony's basis is $80,000. Item C, here is our true tale of woe. Suppose Ebony's 18-year-old son uses the car for his personal use for 1 year before Ebony sells it for $28,000. How much loss may Ebony recognize on the sale of the car? No deduction for the loss on the sale of the car. The son, that kid, converted that asset to a personal use asset. No deduction for loss on the sale of a personal use asset. So what was her loss? Well, $80,000 minus $28,000, $52,000. Non-deductible loss. What tax planning procedures should be considered? First, well, my first one is keep the kids' hands off the car. That's not what I wrote, though. I wrote, Somebody could take $35,000 cash distribution from the partnership. Partnership says, wait a minute, you can't take all of our cash. We had other distributions we needed to make. Well, no, give me the 35,000 and then I'll give you 30 back for the car. I'll purchase it for its fair market value of 30. So you still only gave me 5. And then you gave me the car, but I bought the car from you instead of receiving the car as a distributed asset. Now, if I give it to my kid and let him drive it around, well, okay, it becomes a personal use automobile that way. And, I still can't deduct the $2,000 loss, but that's a lot better than the being not able to deduct the $52,000 loss. If I took a $35,000 liquidating distribution, I would have had a $50,000 loss on the liquidation of my partnership interest, which I could deduct. Now, the answer guide to the textbook also said, well, Ebony could have used the car in a business and then it would not be a personal use asset. And so she could drive it around in her business for a couple of years, then sell it, and she would have a deductible loss. That's certainly true if Ebony just happens to have another business lying around that needs a car but doesn't have one. That seemed to me to be a bit of a stretch, so I didn't enter that. I thought my idea of taking the $35,000 cash distribution followed by a purchase of the car for fair market value of $30,000 sounded to me like a better idea. Okay, liquidating distributions are classified as income distributions or property distributions. Income distribution include payments for a partner's share of unrealized, that would be mainly cash basis receivables. Income distributions also include payments for the partner's pro rata share of unstated partnership goodwill. Essentially, you've earned that money through your partnership activities. You just haven't converted it into money yet. So those are income distributions, and property distributions are all other liquidating distributions. Once you've taken care of your unrealized receivables and your pro rata share of unstated partnership goodwill, everything else is a property distribution. Remember what we said about hot assets. For liquidations, hot assets still include those unrealized receivables, but do not include the 1245 assets. So property distributions are all other liquidating distributions. They are payment for accrual basis receivables, inventory, property, plant, and equipment, and stated goodwill. Partners receiving income distributions treat them as ordinary income. Property distributions in excess of basis are capital gains. So clearly the partners, if they're terminating the partnership, probably would like as much of that to be capital gain as possible, all else equal. But if it's cash basis receivables or unstated goodwill, it's going to be ordinary income. Partnerships may deduct income distributions to general partners as guaranteed payment. If this is a liquidating distribution to retire a particular partner, but not a liquidation of the partnership, then those deductions will be important to the remaining general partners. Partnership gets no deduction for income distributions to limited partners or to any property distributions. So while the partners might prefer property distributions, the partnership and the remaining partners would certainly prefer income distributions because of that deduction. Sometimes the partner's outside basis in the partnership does not equal the inside basis according to the partnership's books. Remember, we said we were going to talk about what happens when outside basis and inside basis diverge. So here we go. This can occur if, first of all, a partnership interest is sold. We'll do an example of that in just a second, but it can also occur if a distribution happens in which the partner takes property at an amount different from the partnership's basis in the property. So the partner was close to zero before taking the property, and then in order not to make a basis go negative, they had to take the basis of the property at an amount less than the partnership's basis. So that would also cause a divergence between inside and outside basis. Let's look at the first example. A partnership interest is sold. So January 1, A has a $20,000 interest and B a $20,000 interest. AB partnership has a $40,000 capital account. So inside basis and outside basis are now the same. Then we have earnings for the year. 15,000 for A, December 31st. A's account is at 35,000. B also gets 15,000. So B's December 31st account is also 35,000. Total earnings obviously 30,000. So the AB partnership partner's equity is at 70,000. Inside and outside basis are equal. But C purchases A's partnership interest for $45,000 the next day on January 1st. Her outside basis is what she paid for it, $45,000. But her inside basis is her partner's equity account on the books, and that is still at $35,000. The partnership was not a party to that transaction. That was a deal between A and C. B obviously had to agree to it. You can't admit a partner without all the other partners agreeing. So B signed off on the deal, but the partnership was not a party to the transaction. So now C is in a position where, well, I paid $45,000 for this, but the books say my basis is only $35,000. If inside and outside basis have diverged, as they have in this case, the partnership can elect to adjust the basis of its assets to bring inside basis and outside basis back to equality. So we didn't look at the asset side of the balance sheet for the AB and now the BC partnership, but obviously there were some undervalued assets or unstated goodwill if C was willing to purchase the interest for $45,000. So this election to adjust the basis is made at the partnership level. So it's a partnership election, not an election by the partners. It happens in any year in which a transfer of partnership interest or a distribution occurs. So anytime inside and outside basis get out of whack, the partnership can make this election if they want, or they don't have to. It's an election. Election is effective for the year in which it is made and all future years. It's irrevocable without IRS permission. So they say, okay, if you want to do it, that's fine, but you can't just do it and then say, oh, never mind if it turns the other way for you. So you're going to need IRS permission to undo your election. Election adjusts the basis of the partnership assets, and the adjustment will pertain to whatever partner or partners have an inside basis different from their outside basis. So let's take a look at problem 34. We'll see how this works. Damon owns a 20% interest as a general partner in the Vermilion Partnership, which provides consulting services. The partnership distributes $60,000 cash to Damon in complete liquidation of his partnership interest. Damon's share of the partnership's unrealized receivables immediately before the distribution is $20,000. The partnership has no other hot assets. None of the cash payment is for goodwill. Damon's basis in his partnership interest immediately before the distribution is $30,000. So letter A, how is the cash payment treated under section 736? We're going to treat that as a distribution of $40,000 cash plus $20,000 for the receivables, because this was a disproportionate distribution of $60,000 in cash. His proportionate share of the receivables was 20%. 20% of $100,000 is $20,000. Letter B, how much gain or loss must Damon recognize on the distribution? What is the character of these amounts? Well, remember, Damon received $60,000 cash. The basis in his partnership interest was $30,000. So there's a gain of $30,000. What is the character of that gain? Well, $20,000 we are going to treat as if it was a distribution of receivables. So $20,000 of that is ordinary income The other 10 is a long-term capital gain. I'm assuming long-term. It didn't say how long he's been a partner. Let's assume it was more than a year, then it's a long-term capital gain. Letter C, how does the partnership treat the distribution to Damon? Partnership will deduct $20,000 as a guaranteed payment, as a payment of ordinary income. Letter D, what planning opportunities might the partnership want to consider? Consider electing the 754 basis adjustment. That would have increased the basis of the partnership assets to reflect that $10,000 gain recognized by Damon. Letter E, how would your answers to parts A, B, and C change if Damon had been a limited partner? Would the partnership be more likely to prefer Damon's treatment as a general or limited partner? Damon's recognized gain would not change if Damon had been a limited partner. He still would have had $20,000 of ordinary income and $10,000 of capital gain, because there still would have been that disproportionate deal with the receivables. The partnership would not be able to deduct any portion of the payment as a guaranteed payment, however, if Damon was a limited partner. Therefore, Damon is indifferent. It's $20,000 ordinary income and a $10,000 capital gain either way. Partnership prefers to treat Damon as a general partner so they can get the $20,000 deduction. By the partnership, we mean the other remaining partners, who are the ones who are going to benefit from that deduction. Problem 35. December 31st balance sheet of the GAB LLP reads as follows. Now, this is an LLP, not a partnership, but it's going to be taxed like a partnership, so it's essentially the same thing. So we have the balance sheet there with cash, receivables, and some capital assets. And then Gina, Adele, and Brittany are the three partners. Gina and Brittany look like 25% partners, and Adele is a 50% partner. Capital is not a material income producing factor for the LLP. Gina is an active general partner and owner of 25% interest in the LLP's profits and capital. Letter A, on December 31st, Gina receives a distribution of $140,000 cash in liquidation of her partnership interest. Nothing is stated in the partnership agreement about goodwill. Gina's outside basis for the partnership interest immediately before the distribution is $90,000. So it's a liquidating distribution of $140,000. Number one, how much is Gina's recognized gain from the distribution? What is the character of the gain? The amount realized is $140,000. Her basis is $90,000, so her realized gain is $50,000. Implied goodwill, $140,000 minus $120,000. That is the fair market value of Gina's capital account. So that's $20,000 of implied goodwill. There's no stated goodwill. Gina's share of cash basis receivables is $25,000. The total receivables $100,000, and Gina's a 25% partner. So $50,000 gain, $45,000 of that is an ordinary gain, 20 for the goodwill, 25 for the cash basis receivables. The other 5 is a capital gain. Number 2, how much can GAB claim as a deduction? $45,000 as a guaranteed payment. The LLC is going to be subject to the same rules as a general partnership, $45,000 guaranteed payment. Number 3, what action might the partnership want to take? A 754 election, that is the basis adjustment, will increase that capital asset by $5,000 by the amount of Gina's capital gain. Letter B, now assume that Gina sells her partnership interest to Jess for $140,000 cash. Sale of partnership interest for $140,000. So this is not a liquidating distribution. Number 1, what is the amount and character of Gina's gain? The amount realized, $140,000, basis 90, realized gain 50. That hasn't changed. But only the share of cash basis receivables is ordinary. That goodwill is not going to be counted as a portion of the ordinary income. So $50,000 gain is now $25,000 ordinary, $25,000 capital. So Gene is definitely better off with that result than the other one. Number 2, what deductions can be claimed by the LLP? None, because a sale to another partner, the partnership isn't even a party to the transaction. They don't get any deduction for that transaction. Number 3, what action might Jess request of the partnership? Well, now Jess is the one paid extra for these assets which have a book value less than their actual value. So Jess requests a 754 election to avoid having to recognize income on the collection of the receivables. That's going to be the biggest deal for her. And it also will raise the basis of the land and put some goodwill on the books. Number 37, BDD partnership is a service-oriented partnership that has 3 equal general partners. One of them, Barry Evans, sells his interest to another partner, Dale Allen, on December 31st. So Barry, David, and Dale are the 3 partners, but it's about to become David and Dale. And so Barry is just going to sell his interest to Dale, and Dale will become a 2/3 partner. They are right now, the 3 of them, each 1/3 partners. Assume that the capital accounts before the sale reflect the partners' bases in their partnership interests, excluding liabilities. So each partner has a basis of $40,000. There's also a $30,000 note payable, and we are to assume that the inside and outside basis of each partner's partnership interest is $40,000. The payment exceeds the stated fair market value of the assets because of goodwill that is not recorded on the books. So the payment of $90,000 is more than the stated fair market value of the partnership interest. Letter A, what is the total amount realized by Barry on the sale? Amount realized is cash of $90,000 plus discharge of liabilities. There's a $30,000 note payable there. So Barry's share of that was $10,000. Total amount realized is $100,000. Letter B, how much, if any, ordinary income must Barry recognize on the sale? Well, the amount realized, $100,000, basis, $40,000 equity plus $10,000 debt is $50,000. Realized gain is $50,000. Ordinary income portion, that will be the share of receivables. We have $90,000 of receivables, and Barry's share of that is 1/3, so $30,000. Letter C, how much capital gain must Barry report? Capital gain is going to be the other $20,000. Total gain was $50,000, so $30,000 ordinary, $20,000 is capital gain. Letter D, what is Dale's basis in the partnership interest acquired? Basis of the partnership interest acquired is cash paid of $90,000, liability assumed of $10,000 for a total of $100,000. Letter E, refer to Regulation 1.751-1A3. What information is the seller required to provide? Well, I didn't take you through that particular reg, but here it is. You have to show the date of sale, total gain recognized, portion of that gain that is ordinary, and the capital gain. So we've got all of that information, actually, except for the date of sale. I don't think they told us that. But that would be, obviously, Barry would have that, and as would Dale. Letter F. How would Barry's tax result differ if instead BDD distributed $90,000 of its cash in liquidation of Barry's interest, with the remaining partners assuming Barry's share of partnership debt? In a liquidating distribution, total gain is still $50,000. That hasn't changed. But $35,000 is ordinary. That's the unrealized receivables plus the implied goodwill of $5,000. The other $15,000 is capital gain. Next problem, 38. Anna, a partner in the cash basis HDA partnership, has a 1/3 interest in the partnership profits and losses. Partnership's balance sheet at the end of the current year is as follows. We have cash, receivables, and land. And then the 3 capital accounts for Hannah, Diana, and Alexis They are three equal partners, basis of $90,000, fair market value of their partnership interest, $250,000. Diana sells her interest in the HDA partnership to Kenneth at the end of the current year for cash of $250,000. Letter A, how much income must Diana report on her tax return for the current year from the sale, and what is its nature? Her amount realized, cash, $250,000. There are no liabilities, so that's it. Her basis in the partnership interest is $90,000, so she has a realized gain of $160,000. Half of that, $80,000, will be ordinary income because that's her share of the accounts receivable. The other half will be capital gain. Letter B, if the partnership does not make an optional adjustment to basis election, what are the type and amount of income that Kenneth must report in the next year when the receivables are collected? He will have ordinary income of $80,000 when those receivables are converted to cash. Letter C, refer to example 35. Describe how an out-of-balance situation arises and is resolved for Diana's sale of the partnership interest. Note that example 35 related to a distribution that caused an out-of-balance situation. Prepare a spreadsheet that illustrates the out-of-balance and how Section 754 adjustment can restore balance. So with the 754 basis adjustment, cash has a basis of $120,000. Accounts receivable will have a basis of $80,000, and the land will have a basis of $230,000. That gets the other $80,000 of Kenneth's payment. Can't adjust the cash. So that's $430,000 of total assets calculated at basis. Fair market values, $120,000, of course, for the cash, $240,000 for the accounts receivable, and $390,000 for the land. That's your $750,000. The fair market values have not changed. Partnership interest, Hannah's partnership interest, her basis remains at $90,000. Kenneth's partnership interest, with a 754 basis adjustment, he gets what he paid for it, $250,000. And Alexis, she stays at $90,000. So add that up. 90 plus 250 plus 90 is 430. And then fair market values, once again, have not changed. 250, 250, 250, total of 750. Kenneth's basis is equal to fair market value. Hannah's and Alexis's, of course, are not. Letter D, if the partnership did make an optional adjustment to basis election, what are the type and amount of income that Kenneth would report in the next year when the receivables are collected? And also if the land, which we'll assume was used by the partnership in their business, so it's a 1231 asset, what if that land was sold for $420,000? Assume no other transactions occurred that year. Okay. That's it. We collected our receivables and sold the land. Kenneth would report no income from the collection of the receivables because his basis is already $80,000. $80,000 realized minus $80,000 basis equals 0. Realized gain on the sale of the land would be amount realized, $420,000, basis $230,000, total gain $190,000. Hannah gets 90 of that, Kenneth gets 10, and Alexis gets 90, same as Hannah. So there's your $190,000. Only 10 of that goes to Kenneth as a 1231 gain. Finally, problem number 39. At the end of last year, June, a 30% partner in the 4-person BJJM partnership had an outside basis of $75,000 in the partnership, including a $60,000 share of partnership debt. June's share of the partnership's 1245 recapture potential was $40,000. All parties used the calendar year. Describe the income tax consequences to June of both of the following independent situations that take place in the current year. In both situations, explain whether the partnership continues its existence. Letter A, on the first day of the tax year, June sells her partnership interest to Marilyn for $120,000 cash, plus the assumption by Marilyn of the appropriate share of partnership liabilities. So amount realized, cash of $120,000, plus the discharge of liabilities of $60,000, total amount realized is $180,000. Her basis, $15,000 equity plus $60,000 debt, $75,000. So she has a realized gain of $105,000. Ordinary income is the 1245 recapture of $40,000. And the capital gain is the rest, which is $65,000. Letter B. Instead, assume that June dies on April 1st of the current year. June's brother immediately takes June's place in the partnership. No gain is recognized. Income of the current year will be divided between June and her brother, probably 25% to June, 75% to the brother. That will be the default for any income earned evenly throughout the year. If there was some large transaction at one particular point in time, well, then who was the partner at that point in time? Was it June or was it her brother? Brother's basis in the partnership interest will be its fair market value as of April 1st, the date June died. It's the same as with any inherited asset. Basis equals fair market value at date of death. If the 754 election is in place or is made, then the basis of the partnership assets will be stepped up to reflect the increase in the brother's outside basis. And that's it for Chapter 10. We are now done with partnerships. S corporations are next.